You have $10,000 sitting in cash. You could put it in a high yield savings account earning 4.5% and make $450 this year. Or you could put it in a money market fund earning 5.2% and make $520. It might not look like a big difference, but that's $70. Now multiplying that by $50,000 or $100,000, and suddenly we're talking about real money. So which one should you choose? The answer might surprise you because it's not just about the interest rate. Let me break it down for you. Welcome back to KP Money Talks, and today we're settling a debate: high yield savings account versus money market funds in 2026. We're going to compare rates, safety, liquidity, taxes, and convenience. So by the end of this video, you'll know exactly where your cash belongs. If you want straightforward money advice without any bullshit, hit the subscribe button and let's dive in. First, let's make sure we're clear on what each of these actually is, because people confuse them all the time. High yield savings account. A high yield savings account is a savings account usually from an online bank that pays significantly more interest than traditional bank. As of February 2026, top high yield savings accounts are paying around 4% to 4.5% APY. Your money is deposited at a bank. It's FDIC insured up to $250,000, and you can withdraw it at any time. Think of banks like Marcus, Ally Bank, American Express Personal Savings, or it's the AT Bank. Money market funds. A money market fund is an investment product, specifically a mutual fund, that invests in very short-term, low-risk securities like treasury bills, commercial paper, and certificates of deposit. As of February 2026, money market funds are yielding around 4.8% to 5.3%. These are offered through brokerage firms like Vanguard, Fidelity, Schwab, or investment apps. An important distinction is that money market funds are not FDIC insured. They're considered extremely safe, but they're technically investments, not bank deposits. Here are some key differences. High yield savings equals bank account with FDIC insurance. Money market fund equals investments with slightly higher returns but no FDIC protection. Now let's compare them across 5 critical factors. Let's start with the most obvious question. Which one pays more? Current rates in 2026. High yield savings accounts 4% to 4.5% APY. Money market funds are 4.8% to 5.3%. Money market funds are winning by about 0.5% to 0.8% right now. The difference matters. On $10,000, that's $50 to $80 per year. On $50,000, that's $250 to $400 more per year. On $100,000, that's up to $800 more per year. What's the difference? Money market funds typically track short-term interest rates more closely and adjust faster when rates change. They also have lower overhead costs than banks. High-yield savings accounts, on the other hand, are set by banks that have their own profit margins and operational costs to cover. Here's what people forget. These rates change constantly. 6 months ago, the cap might have been smaller. 6 months from now, it could flip. If the Federal Reserve cuts rates aggressively, both will drop. But money market funds usually drop faster and further than high-yield savings account, which tend to be stickier. The bottom line on the rates is that money market funds have a slight edge right now, but the gap isn't massive and it can fluctuate. This is where the real difference emerges. High-yield savings accounts. These are FDIC insured up to $250,000 per depositor per bank per account category. This means if the bank fails, the federal government guarantees your money up to that limit. Your principal is 100% protected. There is zero risk of losing money in an FDIC insured account, assuming you stay under the limit. Money market funds. These do not have FDIC insurance. These are investment products regulated by the SEC, not bank deposits. Money market funds are considered extremely safe. They invest in ultra short-term, high-quality securities, but technically they can break the buck, meaning their value could drop below $1 per share. Has it happened? Yes, but very rarely. The most notable case was in 2008 during the financial crisis when the reserve primary fund broke the buck. Even the government stepped in to prevent a broader panic. Since then, regulations have made money market funds even safer, but the risk, however small, still exists. If absolute and guaranteed safety is your priority, high-yield savings account win. The FDIC insurance is unbeatable for peace of mind. If you're comfortable with a little tiny amount of risk for slightly better return, money market funds are still very safe. How easily can you access your money when you need it? High-yield savings account. Most online banks let you transfer money to your linked checking account within 1 to 3 business days. Some offer same-day transfers or next-day ACH. You typically get 6 withdrawals per month without penalty, though this limit was relaxed during COVID, and many banks haven't reinstated it. Some high-yield savings accounts come with the debit cards or ATM access, though this is very less common. Money market funds. Accessing money from a money market fund usually requires selling shares and transferring to your bank account, which can take 1 to 3 business days. However, many brokerages now offer debit cards or check writing privileges tied directly to your money market fund, making access nearly instantaneous. For example, Fidelity and Schwab let you write checks or use a debit card that pulls directly from your money market fund balance. Who's the liquidity winner? It's basically a tie. Both offer good liquidity, though high-yield savings account might have a slight edge if your bank offers instant transfer. Money market funds with debit card access are just also convenient. Neither should be used for true emergency funds you need within hours. Keep a small buffer in checking for that. Let's talk about taxes and user experience. High-yield savings account. Taxes. Interest earned is taxed as ordinary income. You'll get a 1099 INT form showing your interest, and you pay federal and state taxes on it as your marginal rate. If you're in the 24% federal bracket and a 5% state bracket, your 4.5% savings account is really earning you about 3.2% after taxes. Money market funds. Taxes. Same thing. Interest, technically dividends, is taxed as ordinary income. You'll get a 1099 DIV form. One exception though. If you invest in treasury money market funds, the interest is exempt from state and local taxes. This can be a significant advantage if you live in a high tax state like California, New York, and New Jersey. Treasury money market funds win if you're in a high tax state, otherwise it's a wash. Convenience. High yield savings accounts are simpler. You open the account, link your bank, and you're done. It's straightforward. Money market funds require opening a brokerage account if you don't already have one. There's a bit more setup, but once it's done, it's easy. If you already have a brokerage account for investing, adding a money market fund is seamless. If you don't, a high yield savings account is less friction. So, which one should you choose? You should choose a high yield savings account if you want FDIC insurance and guaranteed safety, you prefer simplicity and don't want to open a brokerage account, you're saving for a short-term goal like down payment or emergency fund, you value the psychological comfort of bank is equal to safe. Best options are Marcus by Goldman Sachs, Ally Bank, American Express Financial Savings, and others. Choose a money market fund if you already have a brokerage account. You want slightly higher returns and can accept minimal risk. You live in a high tax state and can benefit from Treasury Fund tax exemptions. You're comfortable with the investment structure. You have more than $250,000 and want to avoid FDIC limit concerns. Personally, for most people, I'd recommend having both. Keep your 2 emergency funds, that's just 3 to 6 months of expenses, in a high yield savings account for safety and simplicity. Put additional cash reserves, money you don't need, for 6+ months in a money market fund to squeeze out extra returns. You don't have to choose just one. The bottom line is that in 2026, money market funds have a slight edge on returns, but high yield savings accounts offer unbeatable FDIC protections and simplicity. The winner depends on your priorities. Safety versus returns, simplicity versus optimization. If this comparison helped, hit that like button and subscribe for more money content. Comment below, Team High Yield Savings or Team Money Market Funds. I'm curious where you stand. Thank you for watching, and I'll see you in the next one.